Hello candidates, and welcome to the Advanced Auditing and Assurance Learning session. The subtopic is Audit of Banks. To remind you, the general objective of the Advanced Auditing and Assurance paper is to enable the candidates to gain knowledge and skills to undertake advanced audit and assurance engagements in compliance with regulatory frameworks and international auditing standards. The subtopic, Audit of Banks candidates. By the end of this study on the audit of banks, it is expected that you will gain knowledge and skills to enable you to undertake audit and assurance engagements which are in line or in compliance with the regulatory frameworks and international auditing standards. In the study of audit of banks candidates, we will study audit objectives, the terms of engagement, planning the audit of a bank, the internal controls. On internal controls, we will consider the policy paper that was issued by the Basel Committee on Banking Supervision, dubbed Framework for Internal Control Systems in Banking Organizations. Then we will also study the substantive procedures that are required in the audit of banks, then the audit report on the financial statements of banks. So candidates, welcome to the session, Audit of Banks. I just stated that in auditing of financial statements, the auditor should pay attention to the regulatory frameworks and international auditing standards. That is regulatory frameworks and international standards on auditing. The Banking Act of 2015, Section 24, requires that every institution to appoint annually an auditor who is qualified and approved by the central bank, whose duty is to audit and make a report upon the annual balance sheet and the profit and loss account, which are to be submitted to the central bank. That is Section 24 of the Banking Act. Section 24. Section 24 of the Banking Act of 2015. Now, Section 25 of the same Act talks about change of auditors, and such changes of auditors of a bank should be notified to the central bank. And Section 26 of the Banking Act is about auditors' duty of confidence. Auditors' duty of confidence. Now, the audit of banks is governed by the International Auditing Practice Statement number 1006. These statements is about the audit of financial statements of banks. Financial statements of banks. And the purpose of this statement is to provide practical assistance to auditors and to promote good practice in applying international standards on auditing of the financial statements of banks. Learners, it should also be noted that this statement is not intended to be an exhaustive listing of the procedures and practices to be used in such an audit. And therefore, in conducting an audit in accordance with ESAS, the auditors comply with all the requirements of all the international standards on auditing. But we all know that banks commonly undertake wide range of activities. However, most banks continue to have in common some basic activities of deposit taking, borrowing, lending, settlement, trading, and treasury operations, and so on. So this statement, the primary purpose for this statement is the provision of guidance on the audit implications of such activities. I've mentioned the activities like borrowing, lending, settlement, trading, treasury operations, and so on. So before we get into the audit of banks, I think it's important for us to highlight some of the basic characteristics that generally distinguish banks from other commercial enterprises. Basic characteristics of banks. Basic characteristics of banks. Number one is that banks have custody of large amounts of monetary items. Custody of large amounts of monetary items. Large amounts of monetary items, including cash, including negotiable instruments, whose physical security has to be safeguarded during transfer and while being stored. They also have custody and control of negotiable instruments and other assets that are readily transferable in electronic form. So candidates, the liquidity characteristics of these items make banks vulnerable to misappropriation and fraud. Banks therefore need to establish formal operational or operating procedures that are well defined that have well-defined limits for individual discretion and rigorous systems of internal controls. So that is one basic characteristic of banking institutions, that distinguish banks from other commercial enterprises, large amounts of monetary items. Then number 2 is that banks often engage in transactions that are initiated in one jurisdiction and managed yet in another jurisdiction. Transaction is initiated, for example, in one continent, and then the management of that transaction is done in another continent. Number 3, banks operate with a very high leverage. Very high leverage. That means that the ratio of capital to total assets is low. And this increases banks' vulnerability to adverse economic trends and increases the risk of failure. High what? Leverage. They operate with very high leverage, meaning that the ratio of capital to total assets is low. Then another characteristic is that banks have assets that rapidly change. Assets that rapidly change in value and whose value is often difficult to determine. Consequentially, a relatively small decrease in asset values may have a significant effect on their capital and potentially on their regulatory solvency. Another property is that banks generally derive a significant amount of their funding from short-term deposits, and these deposits may be insured or uninsured. Therefore, a loss of confidence by depositors in a bank's solvency may quickly result in liquidity crisis. May do what? May result in liquidity crisis. Liquidity crisis. Another feature is that banks have fiduciary duties, and these fiduciary duties are in respect of the assets they hold that belong to other persons. And these fiduciary duties may give rise to liabilities for breach of trust. So they therefore need to establish operating procedures, internal controls designed to ensure that they deal with such assets only in accordance with the terms on which the assets were transferred to the bank. Next point is that banks engage in a large volume and variety of transactions whose value may be significant. And this ordinarily requires complex accounting and internal control systems and widespread use of information technology. Another characteristic is that banks ordinarily operate through networks of branches and departments that are geographically located or geographically dispersed. This necessarily involves a greater decentralization of authority and dispersal of accounting and control functions, with consequential difficulties in maintaining uniform operating practices and accounting systems, particularly when the branch network transcends national boundaries. Next characteristic is in relation to transactions which often may be directly initiated and completed by the customer without any intervention of the bank's employees. For example, transactions that are carried out over the internet or through the automatic teller machines and so on. So these are some of the basic characteristics of banks that distinguish banks from other commercial enterprises. Now, learners, that will mark the end of our today's learning session, where we've introduced the subtopic audit of banks. And in this session, we've learned that an auditor should have knowledge and skills to undertake the audit and assurance engagements that are in line with regulatory frameworks and international standards on auditing. In this lesson, we also learned that the audit of banks is regulated or guided, or we can say auditors seek guidance, get guidance from the International Auditing Practice Statement number 1006. This statement is about the audit of financial statements of banks. In the lesson, we've gone ahead to identify some of the basic characteristics of banks. These characteristics are common to banks, and the characteristics distinguish the banks from other commercial enterprises. In our next session, we will study audit objectives of banks and terms of engagement. Thank you, and God bless you.